So let me go ahead. Let me go ahead and share a screen. Okay. So this is a talk or a short, brief session on how to build a funding strategy to maximize startup value. As I'm going to skip some of the background stuff. Just by way of introduction, I am a startup CEO coach. I've done 5 startups. The first 2 shut down. The last 3 were acquired. The 4th one there, I was an advisor for. That was also acquired. I wrote a book on startup execution. And as I mentioned, I teach startup training classes. Our focus with Fundable Startups is to provide online.
We're seeing your presentation mode rather than just the full slide.
Okay. Thanks for interrupting. And
still seeing the presentation. There we go.
How's that?
Perfect.
Okay, thanks. So we provide online training, deep dive startup topics. The unique thing that we have with a lot of our training is we package it with digital tools to try to produce actionable value. Okay, so this topic is a very small condensed snippet of a 4-hour training class. I am focused a lot on not just telling people what to do and why, but on how. Having been a first-time CEO with startup number 4, I remember many times people would tell me what to do, but that ended up not being actionable, okay? Because oftentimes it was just, there were a lot of low-level nuances and detail. So that's why a lot of my training tends to go on deep dive. Because we only have 10 minutes to kind of cover this, I'm just going to hit the high-level aspects. This is not legal, tax, or financial advice. Make sure you talk to somebody who knows your specific situation. And we talk about a funding strategy because I think somebody commented on LinkedIn when Taylor posted that you wouldn't try to launch something without a marketing or a sales strategy. Why would you raise funds without a funding strategy? There are 4 components to a funding strategy: approach, sources, vehicles, and targets. The approach answers basically 3 questions: when to raise, why, and how much to raise. Sources: from where. Vehicles: what type of funds, basically a safe, debt or convertible note, et cetera, and targets: specifically from whom. Okay. Going to dive into the funding approach, and it fundamentally is about the inflection points. If you look at the company, a startup's value, it usually grows in some type of stair-step process like this. Okay. So over time, the company grows in value, and there are specific inflection points. And an inflection point is a measurable milestone that dramatically increases your company's value. Here, they would be the red diamonds. So the best time to raise funds is right after you reach an inflection point, because you're at the peak of your value. And when you're at the peak of your value, when you raise funds, you have the best leverage to get the highest valuation and the best terms. I would say that after you hit an inflection point, basically those green rectangles are where you should raise money, which implies there's a bad time to raise money, and it's right before you hit an inflection point. Most founders do not stop to consider what their inflection points are. They just know they need to raise money. But when they raise money non-strategically, you don't know whether you're raising money in the green rectangle or the red. Okay. If you raise in the red, you tend to get poor valuation, poor terms. You don't get nearly as much interest. Even if you do get funded, it's usually not something that is the best deal that you could have gotten. Okay. There's tons of detail about why terms are important. There's actually a lot of experienced investors and startup coaches who say terms are oftentimes more important than even the valuation. Okay, there may be many cases where you'll take a slightly lower valuation for better terms, and it would probably be in your best interest to do so. So conceptually, you need to be able to understand the funding strategy and the inflection points. Let's look at an example of what the funding strategy can do for you. And this is a scenario of, it's fictitious, of how a company would grow. Okay, so with a funding strategy, you learn where your inflection points are, and you raise with the right type of funds, the right amount at the right time. You get very good terms at each one of these fundraisers. Let's assume very quickly you get an exit offer. So you say, hey, I just want a quick exit. I'll take this offer. You get acquired. Everybody's celebrating. Okay. On the far right, without a funding strategy, with the exact same company growth, okay, you actually could raise money non-strategically, where you might raise too much with a convertible note initially, or that convertible note is raised when you are at the bottom of your valuation. That convertible note does not get you to the second inflection point. It gets you past the first one, but not past the second one. So you run out of money and you have to get a bridge loan, which is the equivalent of payday advance loan sharks. Okay, in the startup space, that bridge loan usually does not come with very good terms. Then you finally raise the seed round, and it's a little bit more than you needed to be able to get to the exit. You have the same $40 million acquisition. Let's look at how the math works out. And the numbers here, if you wanted to walk through it, are very defensible. They're not stacked in one direction or another. With a funding strategy, the founders and employees walk away with 31 million of the $40 million acquisition. But without the funding strategy, they only walk away with 8.8 million, which is a 3.5x difference. Okay. I've got tons of examples of how this actually plays out. So again, this is not an aberration. I'm not saying every single situation will be 3 to 4 times difference in payout, but it certainly is measurable. Okay. So I've talked about knowing what your inflection points are. How do you dig into that? All right. So your funding approach is tied to your inflection points. What is an inflection point? How do you identify them for your specific company? There are 4 types of inflection points. One is product, 2 is sales and marketing, another is business development, and then the final one is intellectual property. What you should do as a founder is identify the low-level inflection points underneath each of these 4 categories. And you will usually have multiple low-level inflection points. You take those inflection points and you want to identify the time and the cost to be able to reach those inflection points. That time and cost, you will then organize and sequence chronologically. You may have 2 product inflection points and 1 sales and marketing inflection point, which leads to a high-level funding inflection point. Okay, so it's actually a non-trivial exercise to kind of go through this, because the time and cost factor is, I think it's important to do the bottoms up on. All right. So that's what takes the time. It doesn't have to take months to be able to find out your inflection points. I think in just a couple of days, you can take a reasonable guess at what the high level inflection points would be. But before you start to raise funds against that high level guess, I generally recommend doing the bottoms up, which could take another week or 2, depending on how big or how complex your inflection points are. I think that extra week or 2 to be able to do the bottoms up and know with more certainty, I need $475,000. I don't need 750 to reach the next inflection point. If you raise too much, that's fine. You got more money. It's nice that you got more runway, but you tend to over dilute yourself. Okay, so you don't really notice that until you come to an exit point and you realize, ooh, instead of a higher percentage, you are stuck with a smaller percentage and potentially with unattractive terms like investor-friendly liquidation preferences. Okay, happy to answer any questions, because I realize I'm going through some jargon and kind of cutting to the chase, because like I said, this is normally a 4-hour topic, which I'm trying to condense down into 10 minutes. So effectively, I've got a worksheet that kind of covers the inflection points. I'll just cut to the chase on the back of the worksheet, which I will make sure it gets distributed to anybody who's interested in it. This is a little bit of a difficult worksheet to use because it, again, goes straight to the end of the story without kind of going through the bottoms up. But conceptually, you have the 4 columns: product, sales, marketing, biz dev, and intellectual property. Those are your low-level inflection points, and you want to organize them so that they come up to some high-level inflection points. And here's an example. Okay, so the low-level inflection points are the 4 columns there. What you want to do is organize let's say the product low level inflection point is you finish a mock-up and then it takes 1 month. You do a lot of it yourself. So maybe you only need $1,000 to do that, maybe to pay for some tools or something. The sales and marketing inflection point might be you might get 5 customer surveys done. And that might take you 1.5 months. And again, it might cost you $1,000. If you have a defensible idea, you might actually do a provisional patent filing, which could take you a month, and that's a bit more expensive, 15,000. So conceptually, what that means is the high level inflection point, we would suggest a reasonable high level inflection point would be to raise 25,000. Okay. Somewhere in that range, which allows you to, cover the $17,000 in costs. Okay. And once you've hit that 17,000, when you go off and once you've hit those low level inflection points, you can go off and do your other fundraising to maybe friends and family and say, this is what we've already done. You can show them the mock-up. You can give them show them the customer feedback where people are saying, yes, if you built this, we would be willing to pay $500 a month to subscribe to this service, et cetera, et cetera. And we've already gotten a provisional patent filed. When you can make those claims, it is a lot easier to prove to a very early stage investor that you are making progress, and you're likely, if the next goal is to hit the second high level inflection point, there's 30,000 on the product, 2,000 sales and marketing, 5,000 on biz dev. You might raise 50 to 75K after you've hit the first inflection point. If you're telling the story, this is what you've already done, it's a lot easier to get someone to write, or 3 people to write 25K checks, so you can hit the next high level inflection point, number 2. Hopefully that kind of describes the rough process. And I want to be able to stop, because I could continue going lots of detail, but I want to give people a chance to kind of see how it works out. Or you know what, this slide might be useful here. The 4 individual low level of the 4 categories of inflection points, you identify each inflection point in each category. Then you sequence them chronologically. Then what you want to do is determine time and cost. That time and that summarizes the low level inflection points. Then you group together the ones that make sense to group together into those low level inflection points, which gives you the high level inflection points, which you will then use to be able to raise money against. And as I mentioned earlier, once you have this table filled out, on the far right is where you would see effectively the first inflection point. You probably want to bootstrap 25K. Hopefully you can find that amongst the founders somehow. Next inflection point, is your first non-founder raise, 50K, and that would give you 3 months worth of runway. Once you've hit the second inflection point, then you can actually go to non-friends and family, traditional angel investors looking for 500K. And again, it kind of builds on each, reaching the previous inflection point gives you the footing to stand on to raise the next inflection point. Okay, so I've kind of rambled here.
Oh, Sam, this is awesome. Like, I'm totally geeking out on this. I love it. What you've put together here is fantastic. I love this. We've got a couple of questions in the chat, and then I would just welcome anybody else to jump in the chat. Or if it's a quiet time, you can just unmute yourself. But Jeff, your question, I think, is very salient. Do you want to unmute yourself and give any context to what you're thinking there?
Sure. Sam, this is really great, as Taylor said. You might have answered my question already about milestones versus what you're calling inflection points. And I think it might be the same thing, but you're putting a different perspective on it that is helpful. So maybe you could just speak to if you use those terms differently, mm-hmm. or the same.
Yeah, they're very similar, but I think they're subtly different. Milestone, you can reach a milestone without it being a strong inflection point for you. It still means you probably need to hit that milestone, but the concept of the inflection point is the dramatic increase in value. A milestone might be, hey, I opened my startup bank account. All right, of course you need to do that, but is that going to help you with fundraising? Not really. Okay. So another milestone, you might sign a lease for, a co-working space. That's very important. It allows you to be productive. It doesn't necessarily help you raise funds. Okay. So that's how I look at them. They are similar, but to me, inflection point is a special type of startup milestone.
I like that. That's a great distinction. Rick Hernandez, do you want to unmute yourself, ask your question?
Yeah, my question is kind of more, I have a very small company, like we probably tap out around 10 million per year in revenue. Once we kind of address our total attainable market. So is that like even worth an investor's time? Like this is small potatoes. So I guess my question is, how do you know if you have a company that's fundable with outside investors?
Yeah, so that's where I think you have to segment your target investor audience. If you remember, the funding strategy had the approach, sources, vehicles, and then the specific targets. The sources would change given your environment. Okay, if you think that it sounds like 10 million annual recurring revenue or annual revenue would be
annual revenue.
Okay. If that's the peak, then probably the traditional VC startup investor is not going to be terribly interested. Okay. But that doesn't mean that a non-traditional startup investor wouldn't be. Okay. 10 million is still a reasonable business, especially if your cost to generate that 10 million in revenue is just 5 million. Okay. So if you have a cash printing machine that generates, 2, 3, 4 million a year, that's nothing to sneeze at. You just have to make sure that you do the math on what you're asking for the investment and what the payout would be to the investor. Most people who I see pitch only think about, let me tell the investor audience how great my story is. I usually try to make sure that I'm telling that somehow during the pitch that the startups I work with, that they communicate to the audience how the investor is going to make money, how long it would take, what their projected ROI would be, and things like that. In the full class, I've got some content, or in some of the other training I've got, where I actually spend like 10 or 15 minutes talking about how a VC is measured. Okay. Most people who work for a venture capital firm, unless you're like the general partner, the seasoned rich guy, you've been around, you've got a big checkbook to write. Actually, even a lot of the general partners, they're answerable to their limited partners. There are specific metrics that they are measured on. When you understand how someone is measured, then you can sell to them better. Okay. So I would encourage you to run the math that say, if I'm going to ask my investor for 25 or 50,000, maybe you don't go to a traditional startup investor because that guy wants 10 to 100x returns, but a non-traditional investor who is accredited might be happy with 3 to 5x returns. Maybe your math does support that. And if you can demonstrate a pathway to that point, you could still be a compelling investment.
Yeah, that's great advice and counsel there, Sam. I appreciate that. Ryan, you asked a question about different industries. Do you want to elaborate?
Yeah, definitely. So I'm very interested in the example, and I know that it's just an example and we can't apply it to our individual situation. One question I wanted to add on to that though is, if you're a bootstrap company in this example, why are you raising 25,000 when your cost for that runway is less? And then similarly going into the high level inflection point 2, is that just to have buffer, or there's other costs that aren't associated with getting to those inflection points?
Right. So in the example that we're looking at here, the green box where you're raising 25K, the intent is that 25K should be raised from the founders, if possible, not from a third party. And when I talk about founders putting money in, it should be treated as a fundraise. When a founder puts money in, you are playing the role of an investor. You need to document how you're putting the money in and how when you put the money in, or your co-founder puts the money in, how that money will be paid back. Okay, whether so the
We're in a
common
very, our company's in a very similar position where we have 3 founders and we all contributed capital and we put that into our agreement. I was just
Right.
curious about like if there was a factor you put on top of your estimated cost, like if you have a 2x to cover your funding needed from those inflection point summaries, or just.
Yeah, I don't like overgeneralization saying if you do the bottoms up, and in the example here, the bottoms up says 17,000 is what you need. So the raise is 25. Does that mean that 1.5x what you need is exactly what you should raise? And the answer is it depends on every startup and what your cash needs are. When one of the things I do is a bottoms up financial model. And I've been told that my model is the most complex, detailed model that most people have seen. It's like 40,000 cells with 700 knobs to turn because I built it as a reusable tool for me because I did all these models so often for startup companies. Okay. I'm actually a tech guy, a programmer. So I built this financial model in Excel with reuse in mind. Okay. But doing that allows you to understand what your projected cash flow burn rate would be. So if you aren't able to raise the next round of funds, like the 50K in this example in time, how much runway will you need? If you raised, if you don't have this financial model, then it's a little difficult to say, always pad it by this percentage, or always, I can't really say that because every startup's different. Okay. I'm sorry. I think you had another part of the question I don't think I've answered.
Oh no, that's so as far as like bootstrapping and pre-seed rounds go in the 2 inflection points, if you're on like a longer development timeline for
okay,
something that needs regulatory approval, does this model change?
No, it actually does not. In fact, you just drill down deeper. Okay, so a simple example would be biotech. I mean, drug development can be 5, 7, 8, 9 years. Okay. And the high level inflection points would obviously be, phase 1, phase 2, phase 3 clinical trials, but even those can be several years apart. Okay. So I like having more granular inflection points, and some of you're going to have to dig into what that might be. For me, my biggest experience was enterprise software. It can take 3 years to build out your enterprise software platform before someone really says, I'm going to pay 25,000 a year or 100,000 a year to use your software. Okay. Well, how do you get an inflection point when you're not really potentially even selling your product until 3 years out? Well, in the enterprise, think through the customer journey. A lot of customers will start with some type of POC. Okay. How do you even get to a POC? So your sales and marketing inflection points would be more granular, and it might be, excuse me, your sales and marketing inflection point might start with, if you're building enterprise software, hopefully you have some contacts already, and maybe it's some type of HR platform, and you are coming from an HR background. Hopefully you've got a dozen or more contacts that you can solicit feedback on. And maybe the first low-level sales and marketing inflection point is we have previewed our idea with 25 different HR professionals. 22 of them said they would absolutely buy it if we built it. That in and of itself can be a very small low-level inflection point where it, again, helps your story that 90% of the people that you preview your idea with, they actually want to buy. And if you can get them, the next point would be, can you get them to do a letter of intent? And of that letter of intent, can you specify a price of what they would pay? Okay. And if they are willing to work with you, how many of these 22 people would say they are going to give you specific requirements where you're doing 1 week long workshops to understand their business and how you can shape the platform to them? You can say, we have done 5 1-week workshops with these different enterprise companies. That means if someone is willing to give you that amount of time, I'd like to think that means there's a lot of interest in what you're going to build, even though it may take multiple years for you to get to that point.
Okay. Yeah, that's very helpful. Thank you, Sam.
Awesome, Sam. There are a few more questions in the chat. Typically, we'll end around 11:45, but Sam, if you're willing to go until noon, we can block that time out. Is that okay?
Yeah, not a problem.
Okay, because we've got a lot of good questions, and this is amazing just to have you educate us and share your knowledge. So, there was a question about getting your presentation, if that's possible or something like that. People are asking for that.
Sure.
And then any feedback on funding platforms like WeFunder?
Okay. So WeFunder, I assume this is for equity crowdfunding and not rewards-based crowdfunding. Okay, is that correct?
Yeah, equity crowdfunding is what I was curious about.
Okay, yeah. That's the next module I was going to add and build out on my funding strategy class. Historically, equity crowdfunding was kind of the dark horse where most people in the venture community did not think highly of it. It used to be that if you went down the equity crowdfunding path, it was because you couldn't raise traditional venture funding. And if you started down the equity crowdfunding, once you tried to raise traditional venture funding, they would look down their nose at you. Okay. I don't think that's necessarily the case anymore. If you look at the statistics from a WeFunder or from a Seed Invest, they're all seeing like 2 to 3x growth in the past 6 months in equity crowdfunding. What used to be, the option for less fundable companies is more an option for companies that just don't want to go through the pain of traditional VC fundraisers. So I think this is something definitely to pay attention to. You'd end up having to do a lot of the same things that you have to do with traditional venture fundraising. One thing to be aware of is some of the operational detail. Just about all the platforms nowadays claim to have a single line item on your cap table. And this is important because early renditions of equity crowdfunding, if you raise money from 500 people, then you'd have 500 names on the cap table, which is a pain in the butt to manage. Just about all the platforms now say they have a funding vehicle instrument, which consolidates that all into one line on the cap table, which is great. However, there are certain things where operationally they may still require a lot of painful processes to get majority votes and things like that. My preference right now is if you're going to go with an equity crowd fund, without tons of other data, I would probably say look for an equity crowdfund platform that will use a special purpose vehicle, an SPV, instead of the CrowdNote or CrowdSafe, which they all claim to do the one line. But when you're doing some type of major corporate action, maybe the next fundraise or potentially an acquisition, you still have to get a lot of approvals, and that can be kind of difficult when you have 500 names, even if it's all on one line on the cap table. When you go down the SPV route, you designate another company, which is the special purpose vehicle, to be the one line on the cap table. And there is a lead investor who basically decides for everybody who invests. So you only need to get one signature. Operationally, that's a bit more clean. Okay, you just need to convince the guy who, or the small number of people who control the SPV that going down this route from a corporate perspective makes sense, and it's operationally a lot simpler. Do be aware that when you go down the crowd fund, one complaint has been you disclose a ton of information to everybody who's invested. Okay, so quarterly milestones, revenue numbers, etc. That may not be stuff that you want to get out there. You may end up, not that it's going to happen very likely, a competitor could buy into your crowd fund and then get all sorts of visibility into how you're doing.
Yeah, that's good to understand. Wow. I have 2 questions for you, Sam. One is, if people are interested in following up with you or engaging you somehow, how do they do that to help them in their business? And then second, how do you know when you've created enough value in your value inflection point for that to be a good time to raise funds.
Right. Yeah, feel free to reach out to me. My website's fundablestartups.com. You can see tons of info there. There's a lot of free content in our free members area, which is the free resources. We have a 45-minute preview of the funding strategy class that's out there. So that's probably better than the slides because you get a snippet of the 4-hour class. So I'd encourage you to sign up for that. If you wanted to reach out, I can put my email right in the chat. And feel free to reach out, or if you want, you can reach out to me on LinkedIn. Just tell me where we met, because I get a lot of inquiries that feel very spammy. So either on LinkedIn or my email, which I'm typing in the chat right now.
Awesome.
Okay.
Perfect. And then my second question around when you know you've created enough value, like you had a slide that built up the different sub milestone or sub value inflection points. How do you know when that's a big enough value inflection point?
Well, you kind of have to test it with your audience. Okay. I don't know if there is a secret formula. When you have reached a compelling story, then your fundraising will go faster, easier, with less pain. Okay. So it's almost like saying you'll know when you know. I know that's not a very actionable thing. But I don't know if there's an easy way to say, yes, once you've done this, you've hit the right point. If you're doing a lot of presentations and you're just not, you're sending a lot of solicitations out and you're just not getting the responses, then I would take a look at your message, maybe work with whoever is advising you or wherever your source of knowledge is, and try to get them to brainstorm on what is potentially happening. Especially one of the things that one of the things that I don't feel very good about is that the average investor, when they hear a pitch, they don't give a lot of actionable feedback. Maybe a little bit, 1 minute of verbal feedback, 2 minutes, and that's about it. I try wherever possible to provide written feedback using a structured pitch scorecard, because without that, sometimes it's really hard to know what worked, what didn't work. So very few investor audiences that you pitch to will do that because it just takes more time. But my goal is to try to do that. If anybody's going to spend their time to pitch to me, then I think they deserve a little bit more than just a 90-second soundbite in return.
Yeah, that's great. That would be amazing feedback. Well, anyone have any other questions? Did I hit all of them? I was trying to go through the chat. It looks like Karen's going to be doing Start Engine, a crowdfunding platform. That's awesome. But any other questions for Sam? Okay, Sam, this has been amazing. Thank you so much. Really appreciate your time, and everybody feel free to reach out to Sam. As he mentioned, he's got his email in the chat. Copy that real quick, but thank you, Sam. This was awesome. Really appreciate it.
Fabulous. All right.
Yeah, we'll see everybody next Tuesday. Thanks so much.